Welcome. I'm Michael Bickert. Thanks for joining me today as we explore concepts with the objective of improving your management skills and growing your business. You know that thing I do where I always tell you to grab a notepad and a pen? Well, I need you to do that right now because today you have homework. I will tell you up front, I've got a little homework assignment for you. You know that other thing I do where I state something obvious and then I say, well, it may seem obvious, but we should explore this in a little greater depth. If you'll indulge me, I'm going to do that again today. All right, so here we go. Every single expense that your business incurs should be viewed through the lens of return on investment. So what I want you to do, the homework assignment today, is we're going to look at your expenses and we're going to evaluate. I say we, and that's the royal we. You are going to look at your expenses and evaluate the return on the investment that you're getting. Again, it's something that is like, it seems obvious, like, well, yeah, I know when I spend some money on my business, I expect a return on that investment. That's a resource that I'm investing. I want to leverage my resources and get a return on my investment. And yet, I think things get away from us over time. The more that you get in the day-to-day grind of your business, you start to incur a greater number of expenses, maybe a greater overall amount of, as measured by dollars, in expenses, and it can get away from you. And how often are you going back and looking at them individually and evaluating them in terms of necessity and, most importantly, on return on investment? So I'm going to give you some specific details of how I want you to carry out this exercise. But first, I want you to just sort of do a little bit of examination of conscience here and to determine whether or not you think this is a good idea and whether your business would benefit from this. I want to make my case, and once you've done that, once you figure, we all act in our own self-interest. Once you realize, hey, what's in it for me? I'm going to drive my business forward. I'm going to get better return on my investment. Once you accept that, then you'll go into this with a little more vigor and you'll emphasize this a little bit more. Now, if you hate accounting, that's fine. You may want to involve your accountant. I would highly recommend that you involve somebody who has a little bit of accounting experience if that's something that you find that you're weak in. But you should be doing this as the manager, as the business owner, as an entrepreneur. You need to wrap your head around this, become familiar with this, and then I want you to, instill this as part of your culture. Share with your team. If there's others on your team, make sure that there's nothing secret here. Let them know that each of us needs to look at all of our expenses through the lens of return on investment, and is there an acceptable return on investment? You're probably not the only one in your business that has the authority to approve an expense or to incur an expense. And insofar as that's the case, you want to make sure that those other people that are empowered to make expenses, your business partners, your management team, maybe there could be a variety of people on your team who have the ability to make expenses. You want them to understand, look, when you're making an investment, or when you are incurring an expense, when you're making a decision to move forward with an expense, look at it through the eyes of the business, through the eyes of the business owners, and ask yourself, what return can we expect on this investment? This is an investment. And also, today we're going to focus more on the financial aspect, but I want you to also quantify the investment you're making of your time in anything. Remember, that's another very important resource. So you can look at all of your resources, so the use of your equipment, because there's wear and tear on your equipment, the use of your facility, because if you weren't using it for one thing, you might be able to use it for another and get a better return on investment by using it in another way. You can look at all of your resources and consider what return you get on your investment. I highly recommend you do that. But today I'm probably going to focus more on the financial aspect of things. Try to quantify things financially, especially your time. That's a real big mistake that I see entrepreneurs making, and that is that they will invest time in something and they don't pay themselves for it. You should, on your books, you should make sure that you're paying yourself for each and everything you do. And if you're like, well, I draw a particular salary, that's okay. Then what you have to do as it relates to your time is you have to do those things where you figure out what are you spending your time on, and you have to remind yourself how much your time is worth. So I don't know, perhaps the salary you pay yourself works out to $100 per hour or $50 per hour or $1,000 per hour. I'm not sure what it is in your case. You've got to quantify that. And then when you're engaged in something in your business, you have to realize, hey, we are spending, if let's say there was 1 hour of your time going into something, and we use the nice round number of $100 an hour that your time is worth, you say, I spent $100 on this, and therefore you then start to look at the return on the investment in your time. So let's get into some of the details of how you're going to go about doing this homework assignment. The first thing you're going to have to start with is your financial statement. Take your income statement. If you do not have that, you're going to find that this exercise exposes maybe some other areas of your business that you should be working on and tightening up your management skills a little bit. So you should know where to go right now to quickly access, and you don't have to do it right now, but quickly access a financial statement. And within that financial statement, typically you'd have your balance sheet up front and then followed by the income statement. So it's the income statement we're going to focus on today in a lot of our discussions. But if you don't have that, then reach out to your accountant, whoever prepares those reports for you, for your financials for you, make sure they send them to you. Now you may say, well, should I be looking at a monthly financial statement, a monthly income statement, or my year to date or last year? That's up to you. Actually, there's an argument to be made, and there's pros and cons for doing it different ways. So if you do this exercise more frequently, which I'm going to recommend you do this a minimum of once per year, but the more frequently you do this, then you can look at smaller sample sizes. But if this is the first time you're doing it, and I think for many of you it probably is, then you're probably better off looking at a larger sample size in terms of time. That'll give you a greater sample of expenses. Of course, one of the disadvantages of doing that is you may have a more recent expense that doesn't fall in. Let's say, for example, you took last year's income statement to look at, and you've made a new investment this year in some new equipment or a new employee or whatever, some new software. There's new expenses that you've incurred this year. They're not going to be shown on last year's income statement, of course, if they're new. That's obvious. So that's one of the reasons that it may benefit you to do this on with different financials, with last year and then maybe this year to date and maybe just this month. I would recommend that you do this periodically, as often as even every month would be a great idea. You'll get really good at this and you'll get to go through the exercise much faster. So what we're going to do then is, of course, on your income statement, you're going to have at the top of your income statement, it'll talk about your sales, followed by your well, you'll have your sales and the various way that you make sales, and it'll add that all up, and then you'll have your expenses, your line items, and various accounts underneath that of your different categories of expenses. And depending on how your income statement is laid out, these can be in very broad categories, you know, cost of sales and that kind of thing. I'm not going to get into the anatomy of an income statement today, and we can do another video on that. And if you're really weak on that, that's where you might benefit from having somebody in your accounting department guide you through this, or just choose another YouTube video where they walk you through the typical income statement. But each of the expense categories is actually, like the name would imply, is a category of expenses. It's not likely to be an individual expense. For example, if you have an employment expense on that, that might include, or probably should include, all the expenses for everybody in your business. Now, the other thing about an income statement is it can be broken out. The first page would likely be for your entire operation, and then if you have different departments that you break that out for, you would have departmental income statements. And I'll leave it up to you when you're doing this exercise if you want to do this individually through departments or you want to do your overall company. I'd recommend you do your overall company, and maybe if you have individual departments, whoever's the department head, have them do it for their departments respectively. So anyway, going back to our example of employment expense, that would include all the people that you pay, say, salaries and wages to and that kind of thing. So you see that's a category, that's a bucket into which the accountant is placing all the similar expenses. Later, we can break that out by individual, and you can see where I'm going with this. I think that's going to be the next step. So for starters, as that example, let's just give it a couple more examples. You might have software like technology, IT on there. Maybe you've got some janitorial, or you've got stationery like office supplies, travel and entertainment. These types of expenses are the types of things you're going to find on that. And there's always a little bit of leeway for an accountant to have to make a judgment call along with management of where to place certain expenses if they're not immediately clear. The examples I've given are probably really cut and dried, but occasionally you will spend money on something where you may not realize the accountant chose to put that in a different category of expense than you would have guessed, or that if it were up to you. So again, what I said earlier is that this exercise is going to teach you some things, and as you explore this, you're going to become more familiar. You're going to strengthen your management, and have that communication with your accountant, and you can clarify things if you don't like the way they're laid out and everything. But digging in with a real simple assignment like I'm doing today will be helpful. So now you're looking at your expenses, and I want you to sort of have this scrap paper beside there, and I want you to take notes as you go. And you're not going to do this with every single expense for one exercise. In fact, what you might want to do is break this out monthly and do a different expense category once per month. And you can do actual different line item accounts on different months. I'm getting ahead of myself here, but what I want you to do is look at an individual expense, so a line item on your income statement. And then you'll see, well, here's how much it cost me for whatever time period you're looking at. It might be last year or year to date or this month, or last month, for example. And then you want to ask yourself, what goes in that? So that's the first question you're sort of looking, well, what goes in that? Do you know? As the manager, do you know? If you don't know, then I want you to contact your accountant, or if you're doing your own accounting, dive into that account and look at everything that's included in that. So you're going to need an expense report, an accounting report for that individual account. And that'll give you line items, more specific, more granular details as to what goes into that. But before you look at that report, it just starts with the question of what goes in here. And it's kind of a fun exercise to guess if you're not 100% sure, and then to later reconcile with what you thought went in there. Are there any surprises in that account? You will often find there are surprises, and maybe they're good surprises, maybe not so good, but reconcile your perception with reality and how the accounting is being done. This is a really important thing to do. And so once you've done that thing where you're like, okay, well, what goes into that? The next question you're going to ask yourself is, what is the objective of this expense? Why am I incurring this expense? Is this a good expense for the company to incur? Is this necessary? These are the questions I want you to ask yourself about each of the line items. Now, in my example of employment expense, you may say, well, of course, I need my people to run the business, and even your own salary is in there, and you need yourself maybe. That's a whole nother discussion that we can have, because you may not need yourself, and you shouldn't rely so heavily on yourself. But yeah, I digress. So it may be obvious to say, well, yeah, I definitely need this expense, and the objective of this expense is to be able to operate the business, to manage the business, to innovate, to add more value. Good. All right, so you've made that determination. What is the return you're getting on that investment? That's the question that we start this video with. Are you getting a good return on your investment for, in this example, employment expense? And again, put your perception down. What would you imagine? we can break this out to a percentage, like a percentage of money that you're getting back on your investment. And that's what I'm trying to get you to think. That's the paradigm I want you to look at each of these expenses, because you don't have to employ people. I mean, you may say, well, no, Michael, I can't. I can't run my operation without it. But that's not what I mean. What I'm saying is every time you spend $1, however much money you're spending on one thing is just a choice. It could be spent elsewhere. You could spend that employment expense, instead of on those people, on different people, on outsourcing it as an example. Or instead of investing in your business, which maybe you have a rent factor that you've got to pay, and you're paying employment expenses and janitorial and software and something, you could just invest in assets. You can do that as a corporation. Your company can invest in various asset classes. You could be buying, stocks instead. You could be, and there's been a lot of volatility in the stock market. A lot of people would say presently, I'm not sure when you're watching this video, but presently that there's a lot of appearances of bubbles going on with certain stocks. But you could be putting things into precious metals, into cryptocurrency, into real estate. Anytime you are spending money, it's just a choice that you're spending it in one place versus another. Now, at one point in time, you decided, well, I'm going to spend money to run a business. And then you started to incur expenses with that business. Now, what we're doing now is we're reminding you to frame things through the lens of acceptable return on investment for every expense, because some expenses that you're going to find doing this exercise, that some are not paying the dividends that you would expect to pay. And then you can redirect those funds to something else, or you can apply pressure in that area for whoever manages that area to expect a greater return on investment. You can find out why you're not getting the return on investment in a particular expense, and you can leverage that better. It's all about, you have to focus and then make decisions. It's a bit of an abstract concept the way I'm discussing it, but this is actually quite simple. Don't be intimidated by this, for those of you who really don't enjoy numbers and accounting. Think of this as there's no right or wrong. You're just going in as exploration. Think of it as going for a hike in beautiful nature, and what can you discover? You can't do anything wrong. You're not gonna change all your accounting and all that kind of stuff. You're not gonna be pulling out a whole bunch of receipts and calculators, and well, maybe you probably will use a calculator or a spreadsheet for part of this assignment, but you're not gonna mess anything up. At minimum, you're gonna learn from this. And so I don't want to harp on that, because maybe you're not intimidated. Maybe you're looking forward to this. I hope you are looking forward to this. You're going to learn. This will strengthen you. You will become a more effective manager, entrepreneur, business owner as a result of doing this. Okay, so you've looked in and you're saying, well, I think I get a good return on my investment in this particular category. And I've given you some examples of categories. And now what you want to do is try to quantify it. Come up with a mathematical equation of how you can determine whether or not you're getting a good return on your investment. Let's say that your employment expense on a monthly basis is, I don't know, $20,000 that you're paying out for however many people are in that particular bucket, in that expense category. What the objective of those people, we said as a simple example might be, well, they need to manage the business, they need to operate the business. Okay, so what return are you specifically getting financially from those people's efforts? And if you're like, now I'm stuck, well, we've learned something else in this exercise. And that is probably symptomatic of the fact that you do not have a good report card for individuals in your business, and you want to have that. And we recommend at BMI that your report cards are very much financial based and weighted heavily on finance, that you can get an idea basically just by looking at the report card. Is this a good investment? Am I getting a good return on my investment of this individual? And for your overall company, if your report card is doing well, then you could probably look on that sort of off of your financial statement, off of your income statement. Now you look at your report card, and if you've got other types of things on there that give you a greater insight, because I'm not sure what performance analytics you use on your report card, you might get some insights that are really helping you to align your perception with reality. But now, as I said earlier, what you're probably going to need to do if there's a lot of gray area here where you're like, well, I think I'm getting a good return on my investment of, in this example, my people, then you have to ask yourself, okay, are you getting an equal investment from everyone on your team? The answer is assuredly not. So who is giving you the best return on your investment? And who is giving you a lower return on your investment? And what will you do about that? That's where you're going to need to go and look at that accounting report for that expense category and have it broken out. So in my example of 20,000, there might be, a couple of people making a couple of $1,000 each, and there might be a couple more people that are making more than that, or whatever, however it's broke out. And then individually, you're looking at the return you're getting on investment for each of those. I don't want to harp strictly on the idea of employment expense. So let's use another one as an example, which would be software. So what is your objective of your software? And so you state the objective. It's like, well, to run our business with greater streamline. Here's one of those things where you might have had subscriptions for a lot of software, and over the years, you didn't eliminate stuff that you stopped using. You might find that when you go into that granular detailed view of that account. But again, you have to look at what return you're getting on your investment. What you're going to come up against is you're going to realize that some of these things are very cloudy. It's not clear at all. It's very opaque in terms of being able to ascertain your return on your investment. And that's where you're going to have to figure a way of measuring that and determining that, because it may be simply a subjective thing where you would say, well, yes, we're getting a great return on the investment, and someone else is saying no. Have that discussion with your other stakeholders and then figure out a way mathematically to quantify it. Like, for example, if you have in your software, you have some accounting software. You ask yourself, well, when's the last time we evaluated the value of this accounting software that we chose? If you're on the same accounting software for the last 10 years, perhaps there's something much better out there that you can get a better return on your investment. It does all the same things. What is the accounting software meant to deliver for you? Does it do it? And is there a better? Now, when we're talking strictly about expense, it might have occurred to you by now. It's like, well, return on investment can't just involve expense. It has to involve some kind of revenue, right? There's a return on investment is, what do I get back for what I've invested? And so you might say, well, Michael, software as an example, when we're just focused on the expense, that's strictly an expense. I'm not getting any revenue back from that. That's why we talk about those objectives and what is the objective of the expense. And they come into categories. Now, I've been talking about individual line item categories, but sometimes you have to, on your scrap paper, look at things as a different category, like your cost of sales. You might say, okay, well, all of these expenses here are cost of sales. That should be on your income statement anyway. They all fall in on your income statement into a broader category. And then it's like, are you getting a good return on your investment? And by the way, when you come to those broad categories, your income statement probably will already express the as a percentage what your return is. So you might have on your income statement that particular cost of sales is 97%, leaving you with 3% margin as an example. I'm realizing as I'm recording this that I'm getting too much into a tutorial of accounting, and I never intended for that to be what we do here, and I'm doing a poor job at that. So I should be making more assumptions that you know how to do this, or that you spend some time investigating a little bit, researching a little bit about how your financial statements are laid out and the categories and how to get the information you want. What I want you to focus on today, though, is understanding whether or not you have a good return on investment of each and every expense, and going back to your financials to explore that. Go dig in, go a little bit more detailed and granular to dig into the individual expense accounts and take a look at those. And what you're going to find is there's going to be some expenses that are unnecessary or that you're not really sure what they're for. And then by exploring that, you will be able to discuss with whoever, put that in place, or whoever is most affected by that expense, and find out what is their perception, what is the objective of this expense, and anything that falls, into question, or you look at it and you suspect that it's not a very good return on investment, write those things down. And those are the things we're going to really focus on and apply our management skills to put a strategy in place to either improve the return on investment we get on that expense, bringing that back to, does it generate revenue, and how does it do that, directly or indirectly? Many of these things, of course, will be indirect, how they generate revenue. I was given the example earlier about software and accounting software. Maybe you have another software piece that is meant to allow your customers to book appointments with you. And is it being used, or are you getting a lot of manual and people calling you up to book appointments and you're physically having to do that? These are the types of things that, as you explore this, that's why it's difficult to give example, because I'm not sure what expenses you're going to focus on. But that's where the rubber meets the road, and that's where this becomes practical, where you start to look and you go, yeah, we are investing in that appointment booking software, but I'm finding that most of our appointments are being booked over the phone with our receptionist, or that kind of thing. And then you can start to create a strategy, a management plan for how you're going to either improve the investment, or improve the return on the investment you get, in my example, the software, the booking software, or eliminate that expense. And you will find that the day-to-day things that you and your team are doing are greatly impacting this. Some things, and it's really nice when you can just stroke things off your list and say, well, we're going to stop spending money on that. I have a whole video on, taking a look at your expenses and eliminating that. But today I wanted to focus, and I don't know if I did a good job of focusing on this enough, is getting you to think about every little thing that you're spending money on, and including spending any resource, your time, as an investment, and then trying your best to quantify it, to bring it back to return on investment, which again starts with understand the objective of the expense, what it's meant to do directly or indirectly, how it's meant to generate revenue. All of your expenses should in some way be able to directly or indirectly relate back to generating revenue. And then you're going to tie those together. You're going to say, well, can I quantify how much revenue, even if it's an estimate, I'm realizing as a result of this expense? Now, you may come across some expenses on there that are, you can't easily in your mind think, well, this isn't going to generate revenue. Just another example would be, let's say you're spending some money on a staff party or something, some perks for your team. Well, that's not a direct expense that you're expecting to return to generate revenue, but what you're trying to do is retain your staff. You're trying to keep your staff happy and get the most out of them. And then what you do is you start to measure the return on the investment you're getting on that. Like, is your staff retention high or is it low? When did you start making the decision to incur that expense in the name of a happy team? And did it make a difference? Did it accomplish the objective of it? Like, is this party actually helping you? Are these expenses, providing free, coffee or lunch once a month, or whatever these perks may be that you're providing for your team? Again, what's the return on the investment? What was its objective? It was meant to improve retention of your team. Did it do that? So it may not be a financial measure that you come back with, but you look at the objective. And then if it did, you've got greater retention for your team, less turnover, then you can quantify, well, how much money was it costing me every time I turned over staff? You can start to break it back down to financially, mathematically, and accounting that way. It's really difficult to describe everything that I think this can lead to in a very short time that we have to discuss this together. I think that's where we should get started, and then I'll record some follow-up videos. I'll respond to some comments and questions that I get about this exercise. But get started on this, dig into this, and at minimum, if you're like, no, I'm not doing that, I don't have the time, I would encourage you to find the time for those important things in your organization. But even if you're like, I just don't think I'm gonna do this right away, then at minimum start thinking of every time you spend money, ask yourself, is there a good return on this investment? Maybe you're going into a meeting with a person, and I want you in the back of your mind thinking, I'm saying a person, but what I meant to say was a team member that you have. And I want you to think, what return am I getting on my investment in this team member? And just remember, that money you're spending on anything, regardless of what it is, a member of your team, software, whatever, could be invested in one of these stocks that you've heard that has gone through the roof. Instead, it's all money that could be invested one way or another. And if you're talking about time, of course, you could invest your time elsewhere and get better leverage on time or facility, equipment, and it goes on. This is a broad concept, I understand, and maybe I didn't do a terrific job of communicating how to do this, but I want you to start thinking in terms of return on investment for all of your resources, especially those things which fall into the expense category, make it into your various expenses and onto your income statement. So get started on this and then give me some questions. As I'm sort of saying this out loud into, addressing you, I may not be covering some of the points that are not obvious. So in my mind, I'm kind of connecting the dots, and they might not connect for you, and you're not sure, well, where do I go from here? What's the next step? I can record a whole nother video on that. I can respond to comments. So leave some comments. The whole community learns when you ask questions. So leave some comments or questions that we can all learn from, because we need to learn from one another. Perpetual refinement.